The human behavior to relation to money is always dominated by fear, greed, and hope. Well, candlesticks analysis will help you to understand these changing psychological forces by showing you how the buyers and the sellers interact with each other. Candlesticks are basically a visual representations of what is going on in the market. By looking at the candlesticks, you can get valuable information about the open high, low, and close of the price, which will give you an idea about the price movements. In today's video, you will show this how to recognize the most important candlesticks patterns, the psychology behind their formations, and do they indicate when they formed in the market. This patterns is engulfing candles. These candlesticks formations consist of the two bodies. The first body behind smaller and the second one, in other words, the second body engulfs the previous one. We can have the bearish engulfing bars and the bullish engulfing bars. In the case of the bearish engulfing bars, these patterns tell us that sellers are in the control of the market. When these patterns occurs to the end of the uptrend, this indicates that the buyers is engulfed by the sellers, which signals a potential trend reversal. Why is that? Because buyers are losing controls of the market and the sellers are trying to push the market to go down. The bullish engulfing bar patterns tell us about the market is no longer under the control of the sellers and the buyers are gaining strength. When the bullish engulfing candles forms in the context of the uptrend, it indicates the continuation signals. When the bullish engulfing candles forms at the end of the downtrend, it signals the potential reversal. This example shows the same way how the market change directions when the formations of the bullish engulfing patterns. The smaller body that prevents the selling powers was covered by the second body that represents the buying power. Very important, don't try to trade the market using this price action setups alone, because you will need other factors to confluence to decide whether the patterns is worth trading or not. What I want to do for now is to get a skill to identifying bearish and the bullish engulfing bar on your charts. This is the most important step to add for the moment. Second pattern is to doji candlesticks patterns. Doji is one of the most important Japanese candlesticks patterns. When this candle forms, it tells us that the market opens and the closes at the same price, which means that there is indecisions between the buyers and the sellers. There is no one in control of the market. The opening price is the same as the closing price. The signals means that the market didn't decide which directions will take. A doji could anticipate reversal, or it can be a side of consolidation. So this example shows how the market changed directions after the formation of the doji candlesticks. The patterns was trending up, meaning that buyers had more strength. The formations of the doji candlesticks indicates that the buyers are unable to keep price higher and the seller push price back to the opening price. This is an indication that trend's reversal is might to be on the chart. However, always remember that doji indicates indecisions in the market, and you will often find out during the period of the resting after big moves higher or lower. Third patterns in the Morningstar. The Morningstar patterns is considered as the bullish reversal patterns. It often occurs at the bottom of the downtrend, and it consists of three candlesticks. The first candlestick is bearish, which indicates that the sellers are still in charge. The second candlestick is a small one, which represents that the sellers are in the control, but they don't push the market much lower, and the candlestick can be bullish or bearish. The third candlestick is the bullish candlestick that gapped up into the open and closed above the midpoint of the candle. And this candlestick holds a significant trend reversal signal. The morning star patterns show us how buyers took control of the market from sellers. When this pattern occurs at the bottom of downtrend near the support levels, it signals a potential trend reversal. Here the pattern occurred during a obvious bearish trend. The first candles confirmed the seller's domination, and the second one produced indecision in the market. Basically, the second candle indicates that sellers were struggling to push the market lower. The third bullish candle indicates that the buyers took control from sellers, and the market is likely to move upwards. Next is evening star patterns. The evening star patterns is considered as the bearish reversal pattern that usually occurs at the top of the uptrend. The patterns also consist of three candlesticks. The first candles is the bullish candles, the second candles is the small candlesticks. It can be bullish or bearish. The third candles is the large bearish candles. In general, the evening stars patterns is the bearish version of the morning stars patterns. Here the market was trending up. The first candles in the pattern indicating trend to continuation. The second one is short candles indicating price consolidations ending. The final candlesticks moving lower than the previous candlesticks indicates the potential of being a new down move. Another important candlesticks formations is the hammer. The hammer candlesticks is created when the open height and the close are relatively the same price. It is also characterized by the long lower shadows that indicates the bullish rejection from the buyers and their intention to push the market higher. The hammer is the reversal candlesticks patterns that when they occurs at the bottom of the downtrend. These candles forms when the sellers push the market lower after the open, but they get rejected by buyers, so the market closes higher than the lowest price. Here the market was trending down, and the formation of the hammer represents a significant reversal patterns. The long shadows represents the high buying pressure from the point. Sellers were trying to push the market lower, but at the level the buying pressure was more powerful than the selling pressures, which resulted in the price reversal. The most important to understand is the psychology behind the formations of these patterns. If you can understand how and why it was created, you will be able to anticipate the market decisions with the higher accuracy. The shooting star is another important reversal candlesticks pattern. The shooting formation is formed when the open water and the close are roundly the same price. These candles are characterized by the small body, and a long upper shadow is basically the bearish version of the hammer. Very important, the shadow of the shooting stars should be twice the length of the real body. This example shows the perfect shooting stars with the real small body and the upper long shadows. When this pattern occurs in the uptrend, it indicates a bearish reversal sign. The psychology behind the formations of this pattern is that buyers try to push the market higher, but they get rejected by the selling pressures. When this candlesticks forms near the key resistance levels, it should be taken at the high probability setups. Another important formations is the inside bar. The inside bar in the two bar candlesticks patterns which indicates price consolidation. In order to confirm these patterns, you need to see candles on the chart which is fully contained within the previous bar. In this manner, the inside bar candles should have the higher lows and the lower highs than the previous candles. This candlesticks is considered a bearish reversal signals when it occurs at the top of the uptrend, and it's a bullish signals when it occurs to the bottom of the downtrend. In this example, you can see how the trend directions change when the inside bar formations, the bullish inside bar patterns occurred at the bottom of the downtrend. Here sellers were pushing the market lower, price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish inside bar is the opposite of the bullish one, this one occurring on the top of the uptrend indications that the buyers dominating is losing strength, and behind a downtrend is possible. For me, since the inside candles has lower highs and higher lows than the previous candlesticks on the chart, this indicates consolidation bulls cannot manage to create the high heights, and at the same time the bears fail to create the lower lows. As such, there is no sufficient buying or selling pressure to break the previous bar height or low. When these candles patterns happens during an uptrend or the downtrend, it's probably better to see it as the continuation patterns, which offers a good opportunity to join the trend. Twist top or bottom is another useful pattern. So these are reversal candlesticks patterns that signals a potential change in the price directions. The twist bottoms candlesticks patterns is the bullish reversal patterns that can stop at the bottom of the downtrend. It consists of the two candles, where the first candle is in line with the bearish trend, while the second candle reflected more bullish market sentiments as the price moves higher. In the opposite directions, if the price actions happens near a key support levels, it indicates that the bullish reversal is likely to happen. The tweezer top candlesticks patterns of the same structure as the tweezer bottoms, except for the fact that it happens at the end of the uptrend, and therefore it is the bearish reversal pattern. The first candles is the bullish and it contains in the same directions, while the second bearish candles indicates that the trend may be changing soon. The thinnest top occurs when the buyers push the price higher. This gives us the impressions that the market is still going up, but sellers surprised buyers by pushing the market lower and close down to the open of the bullish candles. These two patterns signals price reverse and can be traded when them more efficient if we can combine them with other technical tools. Both the bottoms and the tweezers are only valid when they occur during the uptrend, and the downtrend, the appearance during the choose spike. Trending conditions is particularly meaningless, and it signals the market indecisions to move in the other directions. Candlesticks are flexible, but they shouldn't be used alone in your analysis. You don't open a buy positions every time you spot the bullish engulfing candles, and you don't short the market every time you see shooting star. Candlesticks patterns are best used in the combining with the support and resistance trend lines, and another technical tools such as moving average or pivot points. Also, the time frame is very important, but we are discuss about these concepts in future videos. If you found value and want something new, leave us a like, share, support, subscribe to our channel, and hit the bell icon to stay in touch when we release upload new video. Until next time.